My dear students, in this lecture we are going to complete chapter 6, which is related to how to determine the cost of inventory. We are going to cover in lecture 6 two learning objectives, which is to compute the cost of inventory under periodic system using the four methods of specific identification, FIFO, LIFO, and weighted average. And the second one, we are going to learn how to compute the lower of cost per market amount for the inventory. Before we start the new content, I would like to make a quick recap of the concept that we covered on lecture 5. First, we started to discuss on lecture 5 the inventory systems that a company should choose from and to apply, which is the perpetual system and the periodic system. We agreed that perpetual system is the continuous update of the inventory record that the company will maintain after each purchase is made or sale. While the periodic system, the company will update the inventory records only once at the end of the month or the end of the period or the end of the year. Under these two methods, company will make certain assumptions in order to calculate the cost or the price of the inventory. These assumptions that we discussed last lecture, but under the perpetual system, were the specific identification method, first in, first out, last in, last out, last in, first out, which is a LIFO, and weighted average. So this lecture we are going to include those four methods, but this time under the periodic system of inventory, under the periodic system, using the four methods of specific identification, FIFO, LIFO, and weighted average. In this exercise, we are going to apply the specific identification method under the periodic system. Please remember that under the periodic system, the main aim of the inventory system is to calculate the cost of ending inventory and then to assign cost to the cost of goods sold. So what will happen in reality that the company will come at year end or at the end of the month and will start to take a physical count of the inventory that is there left in the storeroom. And based on that, it will determine the cost of ending inventory under any of the four methods that we discussed, which were specific identification, FIFO, LIFO, and weighted average. So now we have this exercise where a company that's called Trey Monson starts a merchandising business on December 1st and enter into the following four inventory transactions. This problem is the same problem that we solved under perpetual, which was on the previous lecture. I did this on a purpose in order for you to be able to compare between the numbers at the end of the lecture between the perpetual and the periodic system. So you have the same transactions, you have four transactions. December 7th purchased 10 units at a cost of 6. On December 14, purchased additional 20 units for a cost of 12. On December 15, you had a sale of 15 units at $20 selling price. And on December 21st, you have more purchases, which is equal to 15 units, each purchased for $14. Now, I identified in the question that the company used periodic inventory system. So in the exam, before you start to solve the problem, you have to be aware of which inventory system used. Here, we said that the company will use the periodic inventory system. So you are required to determine the cost assigned to the cost of goods sold and to the ending inventory under specific identification, weighted average, FIFO, and LIFO. We will start by the specific identification. If you remember, we said that specific identification, if the company will use it, then the company can identify which exactly units was sold and sold for how much. So now, as we are talking about periodic inventory system, we said that the most important thing for the company, if the company is following the periodic inventory system, is to assign cost to ending inventory and then to assign cost to the goods sold. So the information that's given here is related to the ending inventory. As you can see, for specific identification method, if you know that the ending inventory consists of 30 units, they coming from 15 units from December 21st purchase, 13 units from December 14th purchase, and 2 units from December 7th purchase. So what we're going to do now is we're going to draw this table as we did under the perpetual system, in which we have the dates and activity column, cost of goods sold purchased column, cost of goods sold column, and cost of ending inventory column. We will start by inserting the date. We will analyze the above date given, and we are going to use it to fill in the below table. So as you can see here, we have those activities, and we are going to analyze them in the below table. So now under the periodic system, we are going to ignore the date of sale. We don't care this sale took place on which date, because under the periodic system, the company will come at the end of the month and will start to assign cost to ending inventory and to the cost of goods sold. So the company here doesn't take into consideration the sale of the transaction date, because it assumes that this is not important in calculating the cost of ending inventory and the cost of goods sold. So it will start by December 7 purchase. Now, under December 7 purchase, it's given that units acquired. So units acquired here means that this is the units purchased. They are purchased at $6, and the company purchased 10 units. So we multiply 10 times 60 times $6, we will get 60. So we're going to place this here. 10 units times $6 equal to 60. Then the second date, on December 14, another purchase took place. It was 20 units. Each unit were purchased by $12, so we have a total of $240. So we're going to place it there. Then we are going to ignore the date of the sale, because we don't calculate the cost of goods sold and the cost of ending inventory after each sale is made, because here we are under periodic. We calculate the cost of goods sold and the cost of ending inventory only once at the end of the month. So we are going to ignore December 15 sale, and we are going to move to December 21st purchase. So we are going to list all the purchases that we made during this month. So on December 21st, we have 15 units purchased, and each were purchased for $14, so we will have a cost of $210. Their total, as you can see, is $510. This is the total cost of goods purchased. And then we will start to refer to the information that we have regarding the specific identification. It's given that ending inventory consists of 30 units. So those total 30 units should be inserted at the end of the month. So at the end of the month, the company, after doing the physical count, found that there are 30 units remaining in the storeroom. So those 30 units will be placed in the table here at the last row. Then those 30 units, the company can identify that they are coming from 15 units are related to December 21st purchase. So from December 21st purchase, 15 units are remaining. So we are going to place those 15 units on December 21st under the column of the cost of ending inventory. So from December 21st, all the 15 units were remaining. The company didn't sell any of them. So I'm going to place them under cost of ending inventory column by their cost price, which is 14. So when I multiply 15 units times $14, you will get to 210. Then the second information that we have is 13 units is coming from December 14 purchase. So when we move to December 14, you will find that out of those 20 units, 13 are remaining. So out of those 20 units, 13 units are remaining. So we are going to write the remaining units. So what happened to the difference? What happened to the 7 units, the difference between 20 and 13? They must be sold. So we sold the difference and only 13 units remaining. So we're going to record 13 units with the cost price, the original cost price used to purchase those units. So 13 units times $12 will equal to $156, as you can see. Then the last information that we have is related to 2 units only remaining from December 7th purchase. So we are going to write that under the column of cost of ending inventory that's related to December 7th. So here, out of those 10 units that we acquired on December 7, 2 units only are remaining. So what happened to the difference? It must be sold. So we're going to record 2 units from December 7th using its cost price, which is 6, so we will get $12. So now I can get the total cost of ending inventory at the end of the month. Please be aware that we are doing this process at the end of the month. We ignore any date of sale because we will do our calculation on the last day in the month. So I'm going to add $12 plus $156 plus $210. So I will get at the end cost of ending inventory equal to $378. Now, after I assigned cost to ending inventory, the second important thing to the company now under the periodic system is to get the cost of goods sold. So cost of goods sold simply will be the difference. So here we have 45 units, as you can see, purchased, 45 units purchased, and 30 units ending. Out of those 45 units, there are 30 units remaining. So what happened to the difference? The difference is 15 units. They are sold. So this is another way to calculate the cost of goods sold, is to subtract the difference between cost of goods purchased and the cost of ending inventory. So again, cost of goods sold equal to cost of goods purchased less cost of ending inventory. So here I had units purchased equal to 45 and ending inventory equal to 30 units. So the difference, which will be 15 units, represents sold units. So I now need to determine its cost. I have the cost of goods purchased equal to 510, as illustrated here at the end of the table, and the cost of ending inventory equal to 378. So the difference between them represents the cost of goods sold, which will be 132, as you can see. So if I want to know this $132, its details, I should refer to each date. So on December 7th, you had 10 units purchased, ending 2 units. So the difference between them is 8 units. So I started the day with 10 units. I ended the day with 2 units. This means that the difference, which is 8, are units sold. So 8 units were sold. Each we multiplied by the cost price to get the cost of goods sold. So we will get 48. Then on the second date, which is December 14, we started the date with 20 units. We ended with 13 units. This means that the difference, which is 7 units, represents units sold. So we record 7 units times its cost price, which is 12, so we will get 84. Third and last date, we started December 21st with 15 units. We ended December 21st with 15 units. This means that all units have been sold, so we have 0 units under the cost of goods sold column times $14, so we will get 0. So at the end, we were going to add 48 plus 84 plus 0. We will get the 132, the cost of goods sold. Now, let us discuss the same exercise, but this time under periodic system. So what is the difference between the FIFO under periodic system and FIFO under perpetual? FIFO under periodic will calculate the cost of goods sold only once at the end of the month, while FIFO under perpetual will calculate the cost of goods sold each time a sale transaction takes place. So if I'm going to sell many items during the month, I will have to calculate the cost of goods sold each time sale will take place. This is if I'm following the perpetual system. But under periodic system, which we're going to start to solve now, cost of goods sold is calculated only once at the end of the period. So we have the same data that we used in the previous slide. So we are going to list the transactions, because we're going to assume that sale will take place at the end. So we will not include it in the table. We are going to write down the first column, which is the date of purchases given above, December 7th, December 14th, December 21st, and we're going to write down the cost of goods purchased, which represent in the above table units acquired at cost. We are going to rewrite them there in the table below, as you can see. Then we will start to analyze FIFO. FIFO indicates that first items brought into the company will be the first items that will be sold. So the first items in will be the first item out, and those will be recorded as cost of goods sold. So here we are given that the number of units sold, by referring to the above table, is here on December 15 we had sale equal to 15 units. So we only need here the number of units sold. We are going to disregard the date. We ignore the date under periodic because we will calculate the cost of goods sold at the end of the month. So we will take only the number of units sold, which is 15 units. Under FIFO, those 15 units, under the assumption that we're making, are coming from the first units that we purchased. So we are going to search for the oldest units. Oldest units, according to the date, are the one that was acquired on December 7th. So this means that the first 15 units are recorded in the cost of goods sold, and the remaining units will be included in the ending inventory. So we will take this date by date. We will start by December 7. December 7, we only had 10 units. Why we will start by December 7? Because this is the oldest date. And under FIFO, we are following the assumption that the most old goods will be the first goods that will be sold first. So we will take all the 10 units on December 7th, and we assume that they are all sold. We are going to record them in the cost of goods sold column, 10 units by their cost price, which is equal to 6. So we will have $60. Then, as highlighted now, then total units sold was 15. We only counted till now 10 units. So we still need to take more 5 units from the next date, which is December 14. Out of the 20 units we purchased on December 14, we have 5 units sold. We are going to record them under the cost of goods sold column by its cost price, which will be 60. So now we counted all the 15 units that were sold. We are going to add $60 plus $60. We're going to get the cost of goods sold total, which is equal to 120. Now we need to move to the third column, which is the cost of ending inventory. The cost of ending inventory, as we agreed, will be the difference between the cost of goods purchased column and the cost of goods sold column. So this means that the remaining 30 units are included in the ending inventory. So we will start by December 7th. We purchased 10 units. We sold them all, so no units will be ending. So we will have 0 units. Then on December 14th, we had 20 units purchased. 5 of them were sold. This means that 15 are remaining. So we are going to record the difference, which is 15 units, using its cost price, which is 12. So we will get 180. Then on December 21st, we had 15 units. None of them were sold. So this means that they are all remaining in the ending inventory. So we will record 15 units times its cost price, which is $14, so we will get $210. So now we can add the $180 plus $210 to get the total cost of ending inventory, which is $390. Now let's move to the third assumption, which is LIFO. LIFO assumes that the most recent units brought in will be the first units that will be sold. So this is under the LIFO assumption. However, under periodic, the difference between the periodic and perpetual concerning LIFO is we are going to calculate the cost of goods sold only once at the end of the period. We don't do it like we did under perpetual. Under perpetual, we are going to calculate the cost of goods sold each time a sale is made. So now I'm going to ignore the date of sale and I'm going to calculate it only once at the end of the month. So we are going to rewrite again the cost of goods purchased. We are going to take it from the above table as it is, and then we are going to analyze LIFO assumption. As we said, LIFO means that the last items, the most recent items brought into our storeroom will be the first that will be sold. So those will be recorded in the cost of goods sold. So this means that the last 15 units brought in, because it's mentioned that we have total units sold, as you can see here, total units sold is 15. So we need to ask ourselves, those 15 units are coming from which date? From the most recent date, because we are talking about LIFO. So the most recent date here is December 21st. This is the most recent date. So this means that the last 15 units that will be sold will be recorded in the cost of goods sold column. And the remaining units will be in the ending inventory. So let's start to fill in the below table. So those 15 units will be coming from December 21st. So let's look at December 21st. On December 21st, we purchased 15 units. All of them were sold. So we are going to record those 15 units by its cost price. So we will get 210. This means that the total cost of goods sold will equal to 210, because we will not sell any unit more, because it's mentioned in the exercise that only 15 units are sold. So all the remaining units, all the 30 remaining units, are recorded in the ending inventory. So let's fill in the cost of ending inventory column. So on December 7th, we had 10 units purchased. All of them were remaining because we didn't sell any of them, because under LIFO, we will sell the most recent unit first. So those 10 units will be remaining in our ending inventory. We will not sell them now. So we will record them at their cost price, which is 6. So the cost of ending inventory equal to 60. Then on the next date, which is December 14, we had, as you can see, 20 units. All those 20 units, we didn't sell any of them. So they will be also remaining in our storeroom. So we will include them in the ending inventory. We will include them with their cost price, which is 12, so it will equal to 240. Then on the last date, December 21st, we had 15 units. All of them were sold, as you can see, because under LIFO, we will sell the most recent units first. So nothing will be left in the ending inventory. So it will be 0 under cost of ending inventory on December 21st. So now we can make our calculations. We will add 60 plus 240 to get total cost of ending inventory equal to 300, as illustrated in the last column. Now the last method, which is the weighted average under periodic. Now under periodic system, we compute a single weighted average cost per unit for the entire period. If you remember, under perpetual, we will have to calculate average cost each time a sale is made. Now things will be much easier under periodic system, because under periodic system we are going to calculate the weighted average cost only once at the end of the month. So we are going to compute a single weighted average cost per unit for the entire period. So in order to get this single weighted average period for the entire period, you will have to follow the below rule, which is cost of goods available for sale at the end of the period divided by the number of units available for the sale at the end of the period. So this means we will look at the last row in our table, in the below table that we have. So in the last row in the below table, after we included all the transactions, the purchase transaction that took place, we will have 45 units available for sale. Their cost is $510. So these two numbers, we are going to use them to calculate the average cost per unit. So we will going to divide 510 by 45 units. We are going to get 11.33 dollars per unit. This is the average cost per unit. This average cost per unit, we are going to use it to assign to the ending inventory units and to the cost of goods sold units. So things here are easy because we don't have to calculate the many steps that we did under the FIFO, LIFO, and specific identification. We are going to consider from the above table the number of units sold. We had 15 units. So we have units sold, 15 units. And we had, at the beginning of the day, 45 units. So the difference between the beginning units, all the purchased units, which is 45, and the units sold, which is 15, will be ending units, which will be 30. So now I need to assign cost to those 15 units and to those 30 units. All what I will have to do is I'm going to multiply them by the average cost that I have just multiplied, which is the 11.33. As you can see, I'm going to use this cost, the average cost, the one that I have calculated. And I will do the same in order to get the cost of ending inventory. I'm going to multiply it by the same average cost. So I'm going to get this average cost and I multiply it by the ending inventory units. So I will get 340, as you can see. Now let us discuss the similarities and differences between using perpetual and periodic system. Both periodic and perpetual system, their purpose is to calculate the cost of goods sold and the cost of ending inventory. So both systems use specific identification method, FIFO, LIFO, and weighted average in order to assign cost to ending inventory and units sold. However, the difference between them comes when we talk about the timing on which we will calculate the cost of goods sold and the ending inventory. Under perpetual system, at the end of each day, we will have to calculate the cost of goods sold and the cost of ending inventory, because perpetual means continuous update of our inventory record, while periodic is more traditional system that will only calculate the cost of goods sold and the cost of ending inventory only once at the end of the month. So the periodic system aims first to assign cost to the ending inventory and then to the cost of goods sold. So, if you are a business and you want to determine which method to use to assign cost to your ending inventory and to your units sold, you have to compare between the four methods, and based on the needs of your business, you will determine which costing method that will be suitable to use. So, if you are talking about specific identification, one of its advantages that it's the best to use if you want, as a company, to fulfill the matching principle. If you remember the matching principle, we said that revenues should be matched with the expense. This means that the expenses should be recorded in the same year along with the revenues that they are used to generate. So, when I'm going as a business to use specific identification, whenever I sell any product, I can identify which cost was used. So I'm going to match the revenues and expense and record them in the same period. So I will be fulfilling the matching principle. However, the disadvantage of specific identification that I cannot use if I have a store and in this store I'm going to sell thousands of items, because in this case I cannot keep track of the sale price and the cost of each item because I have thousands of items. So it will not be practical or efficient to use the specific identification. That's why in this case I will have to switch to other method, maybe FIFO, LIFO, or weighted average. So if we're talking about FIFO, if you as a company would like to report the highest income, and this will attract investors to come to invest your company because you are a profitable company, you should use FIFO. That's because FIFO reports the least cost of goods sold, and as you know, cost of goods sold is an expense, and whenever expenses decline, net income will improve. So if you want to report the highest income, and thus will make investors be more attracted to your company, you should use FIFO. However, this will come with a disadvantage that when you report highest income taxes, when you report highest income, this will make you pay more taxes because taxes are imposed on the income. So whenever you have more income, you're going to pay more taxes on that income. So this is the disadvantage. And this will make us move to the third method, which is LIFO. If you want a method that will make you report the least income, and so you will pay the least taxes, you should go for LIFO. Because LIFO reports the highest cost of goods sold. Cost of goods sold is part of the expenses, so whenever expenses are high, income will be low. So whenever you have a low income, this will make you pay less taxes. So LIFO is one of the methods used for tax planning. However, the disadvantage that this will not attract investors because you will report lower net income. So investors will not want to invest their money in your company because you are achieving lower net income. And so, if you want to avoid all the disadvantages of LIFO and FIFO, you should go for the weighted average, because weighted average will give you prices in the middle between LIFO and FIFO. So, if you want to smooth out price changes, you should use the weighted average. The meaning of smoothing out price changes that if you acquiring items for a very high prices and acquiring other items for a very low prices, and if you want to be in the middle, you should use weighted average, because as you know, weighted average assign average cost to each units sold and each units in the ending inventory. However, of course, this method will not be unfair if you are specialized in selling unique products like cars. So if you bought a car for 1 million and bought another car for $200,000, it will not be fair to take the average price and assign the cost to them using the average price, because this would be underestimating the real cost of your unique product. So weighted average is not suitable in case you have a business that's specialized in selling unique products. Now let us discuss the last learning objective on this chapter, which is to compute the lower of cost or market amount of inventory. Now let us explain what we mean by lower of cost or market value through this example. Assume that we have a certain company that purchased inventory on year 2018 and paid for that inventory $1 million. As we always know, inventory is recorded in the financial statement using the purchase price, which will be 1 million. So inventory will be recorded by 1 million. This 1 million represents the purchase price, and we also call it the cost price or the historical price. So according to the lower of cost or market value, the company should evaluate the value of the inventory each year. So assume that on the following year, the company evaluated the value of its inventory and found that the real market value of those inventory after 1 year is only $900,000. So those inventory were purchased 1 year ago by 1 million, and so they were recorded by 1 million. After 1 year, the company re-evaluated the inventory and found out that its real value is only 900,000. So now we have a difference between the recorded price, the recorded purchase price, which was 1 million, and the market value, which is 900,000. This difference represents like a loss for the company, because the real value of the inventory now in the market is lower than the recorded price of the inventory. If this takes place, company must adjust the value of the inventory and record the inventory by its real price. So the company will have to prepare this adjusting entry in order to adjust the recorded price of the inventory. So it will record a decline in the merchandise inventory by 100,000. So it will credit merchandise inventory by 100,000 and will treat this 100,000 like a part of the expenses, a part of the cost of goods sold. So it will increase or it will debit its cost of goods sold by 100,000. This is the rule of lower of cost or market value, which the company will have to do in order to follow the accounting principles. So let us now discuss this exercise, which is related to the rule of lower of cost or market value, that has the following product in its ending inventory. you have road bikes, mountain bikes, and town bikes. You are given the cost of each bike and the market price of each bike and the number of units acquired from each product or each bike. And you're required to compute the lower of cost or market value for its inventory when we're going to apply it separately to each product. Means that we're going to analyze each product. So we're going to look at the table that we have here, row by row. So first, we need to calculate the cost of acquiring each road bike or each product. So for the first step that we need to apply is we're going to need to calculate the total cost price for each product. In order to get the total price for each product, we will need to multiply the units available from each product times its cost price. So please refer to the first row. We had road bikes. Those road bikes we have, as you can see, 5 units. Those 5 units, their cost price, their purchase price is 1,000. So we will multiply the 5 units times the 1,000 to get total cost equal to 5,000. Then we will do the second. We have second product, 4 units acquired from mountain bike. Those units, we purchased them by 500, means their cost price is 500. So we're going to multiply 4 times $500. We will get total cost equal to 2,000. Then the third product, town bike, we acquired 10 units. We purchased 10 units from town bike product. We purchased them, means their cost equal to 400. So their total cost is 10 units times 400. So we will get 4,000. This is the first step, is to determine the total cost price for each product. Then the second step is we need to know the market price. So any product usually has two prices. The first price is the price that we paid for it when we acquired it. We call this purchase price or historical price. And another price that will be in the market prevailing, maybe after 1 year, the real value, the market price of this product will be different from the historical price or the cost price. So now we need to calculate the two prices. Up till now we calculated the cost price. Now we need to do the second step, in which we are going to calculate the market price. So to calculate the market price, you will have to multiply the units times the market price. So we will return back again to the first product, which is road bikes. Now we will multiply the units times, this time, times the market price and not the cost price. So for the first product, we will multiply the 5 units times the $800. So we will get here 4,000. For the second product, we have 4 units, and this time we're going to multiply it by the market price. So we're going to get 2,400. And for the third product, we have 10 units. Their market price is 450. So we will get 4,500. So now we need to know the total market price, which will equal to the totals of 4,000 and 2,400 and 4,500, which should equal to 10,000. So now let us compare between the lower of cost or market price. We will start by product. The first product was its cost 5,000 while its market price is 4,000. So we are going to select the lower of them. So here we have 5,000 and 4,000. The lower of them is the 4,000. So we are going to write it on under the last column, 4,000. Then the second, we have 2,000, its cost price, and while its market price is 2,400. The lower of them will be the cost price. So we're going to include the cost price, 2,000, under the last column. Then the third, we have 4,000, its cost price, while 4,500, its market price. So the lower of them will be the cost price. So now we have 4,000, 2,000, 4,000 again. So this will give us 10,000. We need to compare the cost price with the lower of cost to market, we will see that the difference is 1,000. This 1,000 represent for the company loss, because what happened is the company acquired those goods or purchased those goods at a cost price equal to 11,000 total. Now, when the company will evaluate those inventory in the market, it will find that the real price is 10,000. So its real price or market price falls below its cost price by 1,000. So this means that the prices fluctuates and make the inventory now real value below than the real value that's prevailing in the market. So this 1,000, the company will treat it as a loss. So now we need to adjust the cost of recording the merchandise inventory by preparing the below entry. This entry, we reduced the value of our merchandise inventory by 1,000. Merchandise inventory is an asset, and in order to record a decline in its value, we'll put it in the credit side. And this 1,000, we're going to treat it like an expense or a loss. So we're going to include it as part of our cost of goods sold. So here our expenses increased by 1,000. And by that, we have came to the end of lecture 6. Thank you.